Hello hungry investors out there, this is Ali, and in this video I'm going to talk about index funds versus mutual funds. What are the differences between the two? I'm going to talk about performance histories and other details related to those funds. To start off, both of these funds provide diversification, which is why most people buy them in the first place. The concept of diversification is very important because nobody wants to put all of their eggs into one basket. As of September 2019, index funds held $4.27 trillion in assets, while mutual funds held $4.25 trillion in assets. Now that's pretty close, with a slight recent lead in index funds, which made me think that a lot of people are split between mutual funds and index funds. So hopefully this video can help you decide whether you invest in mutual funds or index funds. So a mutual fund is basically a pool of money which is collected from you, the investor, and is managed by a group of professionals, which they then use it to choose and pick stocks and other investment vehicles to invest your money, and then they charge you a fee for that. So index funds is also a pool of money that is managed by a company, but instead of trying to pick and choose certain investments or certain stocks, they simply buy the entire market as a whole. And because of that, they can charge a low fee because they don't have to hire professional analysts to choose and pick stocks. A simple explanation of the differences between the two is basically mutual fund is a company that tries to find the needles in a haystack, while index funds is a fund that just buys the whole haystack. Hey, if you like this video and you like this type of content, please smash that like button down below and let's get back to the video. Now, one of the best ways to diversify your money and invest in stocks is investing in index funds. Now, this is not just my advice, but the advice of one of the greatest investors of history, which is Warren Buffett. You can invest in an index fund today that tracks the S&P 500 by simply just investing it through Vanguard. Now, if you're living outside of the United States, you can also invest in index funds by investing in ETFs, which are traded in the public stock market of the country you're living in. So when you invest in index funds, you are basically investing in the top 500 biggest companies in the United States. This type of investment is a way better investment than mutual funds, which have a historical record of never beating the S&P 500 over a long period of time. In fact, a book that I read that goes into details about this topic is called Money Master the Game by Tony Robbins. Tony Robbins, which is a great author who wrote many #1 top-selling books, went on this quest to interview the world's most successful investors to try to get the secret sauce that will help individual investors like you and me invest their money wisely. He interviews the likes of Carl Icahn, Paul Tudor Jones, and Ray Dalio, and I'll share some of the results and the findings that he mentioned in that book to help you guys out. If you want to learn more about Tony Robbins' quest, I'll put a link in the description below so you guys can check it out for yourselves. And trust me, whether you're a seasoned investor or just starting out, this book has invaluable advice that will help you in your journey towards financial independence. So let's get into the juicy findings. Industry expert Robert Arnott, founder of Research Affiliates, spent 2 decades studying 200 mutual funds that had at least $100 million in assets under management, and the results are amazing. From 1984 to 1998, a full 15 years, only 8 out of the 200 mutual funds were able to beat the S&P 500 index. That's less than 4% odds for you to pick a winner. That being said, there should be a huge amount of comfort for you to know that by investing in an index funds and getting average results, you are beating more than 95% of the money managers out there. In other words, you're kicking Wall Street's butt just by getting average results. Now, the average cost of owning a mutual fund is 3.17%. Now, you might think that's not a whole lot and it won't really affect the fund's performance that much. But when you compare it with the index fund's expenses, which range between 0.15% and 0.25%, that's a big difference. So with most mutual funds, you are paying 30 times more or 3,000% more than index funds. And for what? Inferior performance? Now you might think to yourself, there has to be a lot of mutual funds that do beat the market, or else why would there be $4.25 trillion in assets under management for mutual funds? So mutual funds certainly do have streaks where they do beat the market. But the real question is whether they will beat the market over a long period of time. As Jack Bogle mentioned, who is, by the way, the founder of Index Fund and the founder of Vanguard, it all comes down to marketing. It's in our human nature to be stronger, faster, and better than the next guy. And thus selling a hot fund is not that difficult. In fact, it just sells itself. And then when it inevitably turns cold, there's going to be another fund that has a recent hot streak as well that is willing to take its place. And that is why the mutual fund business will always be there, because there's always people that are going to try to beat the performance of the S&P 500 so that they can be better than everyone else. But forget all that. Say you're already set and you're 100% that you're going to stick with the mutual fund that you're with right now. So let's go back to the excessive fees part of the equation. To show you guys the impact of high fees on your portfolio, let's assume a hypothetical example of 3 childhood friends, Emma, Mike, and John. All 3 invested $100,000 at the age of 35 in mutual funds. They were all fortunate enough to have an average return of 7% annually. And at the age of 65, they all came together to compare their account balances. Now, on a deeper inspection, they realized that the fees that they were paying were drastically different. They have been paying 1%, 2%, and 3% respectively in fees. So I'm going to show you the impact of fees on their portfolio and on their ending balances, the balances that they should be retiring with. John invested $100,000 growing at 7% minus 3% in annual fees, ended up with $324,340. Mike had $100,000 growing at 7% minus 2% in annual fees, ended up with $432,194. While Emma also had $100,000 growing at 7% minus 1% in annual fees, ended up with $574,349. Same investment, same returns, and Emma has nearly twice as much as her friend John for her retirement. 1% here, 1% there in fees might not seem like a lot, but when compounded annually over time, the difference means that you could not have enough money to retire when you're 65. Keep that in mind. Not just that, to add insult to injury, a sobering study in 2009 released by Morningstar in tracking over 4,300 actively managed mutual funds found that 49% of managers don't own any shares in the funds that they manage. That's right, the chef doesn't eat his own cooking. And out of the rest of the 51%, which is 2,193 managers, only 1,560 managers invested less than $500,000. Remember, these guys earn millions, if not tens of millions, for their skills. So the obvious question is, if the people that run the funds aren't investing their own money into these funds, why the hell should you? That's all I have for you guys today. And again, if you like this video, hit the thumbs up because I try to make these videos as entertaining as I can. Also, I invite you to subscribe to my channel to join the investing community that I'm trying to build. And let me know in the comments down below which one you think is better, mutual funds or index funds. This is Ali, and I'll see you in the next investing video.